School of Management Studies IGNOU presents an audiobook on the course MMPC 003 Business Environment for MBA program. Presenting Block 4 International Business Environment, Unit 11 Balance of Payments, Part 1. After completing this unit, you should be able to explain the concept of balance of payments of a country and its major components, highlight the importance of balance of payments for an economy, and analyze the trends in India's balance of payments. Introduction. The balance of payments for a country can be defined as a systematic record of all the transactions between the economic units of one country, such as households, firms, and the government, and the rest of the world in any given period of time. This includes all the transaction records made among the individuals, corporates, and the government, and helps in keeping the flow of funds in track to develop the economy as a whole. Balance of payments, or BOP, is the sole integral determinant of the health of an economy as well as its relations globally. It portrays the overall transactions of an economy with the other global economies during a given time period in a systematic and prudent manner. Importance of balance of payments. The balance of payments of a country is important because, number 1, the balance of payment reflects the financial and economic status of a country. Number 2, the balance of payments may act as an indicator to determine whether a country's value of currency is appreciating or depreciating. Number 3, the balance of payment statement helps the government in making decisions on fiscal and trade policies. And number 4, the balance of payments statement provides vital insights into the economic dealings of a country with the rest of the world. A close study of the balance of payment statement and its components would help in identifying the trends which might be beneficial or harmful for an economy, and thus helps in taking appropriate economic measures. Components of balance of payments. There are two main components of balance of payments, that is, current account and capital account. Current account includes merchandise, services, transfers, and earnings, and capital account includes loans and borrowings, investments, foreign exchange reserves. Current account. The current account in the balance of payments comprises of the transactions in goods and services alongside transfers during the current time period. Hence, we can say that current account is equal to value of exports minus value of imports plus net transfers from abroad, which means it is equal to net exports plus net transfers from abroad. This becomes our equation number 1. The net exports are also termed as the trade balance, which is the net sum of a country's exports and imports in goods as well as in services. Trade in services is often said to be invisible as they cannot be seen to cross national borders. For instance, when a foreign currency pays for the maintenance of its factory in the domestic home or domestic country, or for the services by a home resident who is working in that foreign country, then the home country is said to be exporting a service. Tourism is one major service export. The trade balance reflects a surplus or positive if the value of exports of a country exceeds its imports, while it is said to reflect a deficit, that is negative, if the value of imports of a country is higher than its exports. Transfers to and from abroad may be in the form of gifts or remittances that residents of one country might send, that is, receive to or from another country. If the net transfers from abroad is positive, it means that transfers from residents in abroad are greater than that sent by domestic residents to abroad. Similarly, the net transfers from abroad is negative if transfers from foreign countries are lesser than the transfers to abroad. Net foreign aid received by a country during a particular period is also a part of transfers. If the right-hand side of the first equation is positive, then the current account is in surplus. It must be noted that large transfers from abroad may put the current account in surplus even if the net exports is negative. However, to keep things simple, the term net transfers will be ignored in the subsequent analysis, and hence the current account will comprise of net exports or trade balance only. Capital account. The capital account records all transactions in assets. An asset may include any one of the type in which wealth can be held, for instance, stocks, bonds, government debt, etc. Purchase of an asset records a deduction in the capital account. If an Indian is purchasing a US car company, then it is recorded as a debit in the capital account of India, as the Indian has to pay in dollars, which means that the foreign exchange is going out of India. The sale of assets, for instance, the sale of share of an Indian company to a US customer is recorded as a surplus in India's capital account, as sale of assets to foreign country will bring foreign exchange into the country. Taking the two accounts together, the balance of payment can be summed up as balance of payments equals to current account plus capital account. Balance of payment is in surplus, that is deficit, if both the current and the capital account combined has a surplus, that is deficit. Thus, a deficit in current or capital account doesn't alone lead to a balance of payment deficit. It has to be outweighed by a large surplus in the capital or current account. Thus, it is very important to keep the basic rule of balance of payment accounting in mind. Basic balance of payment accounting rule. All transactions leading to a net receipt of foreign exchange creates a credit or surplus in the corresponding account, whereas all transactions leading to net payment to foreign countries create a debit, that is deficit, in the corresponding account. When the value of exports for a country exceeds its imports, it accumulates more of foreign exchange, leading to a current account surplus for the country. Similarly, if the sale of domestic bonds to foreign countries, that is, borrowing from a foreign country, exceeds the purchase of foreign bonds, that is, lending to a foreign country, then there is a capital account surplus for the domestic country. A foreign loan repayment, however, is recorded as a debit in the capital account as it involves outflow of payments in foreign currencies. A deficit or surplus in the capital account is termed as net capital outflow or inflow from the country. A current account deficit in a country is necessarily being offset by the capital account surplus in the economy. The balance of payment accounting follows the system of double entry bookkeeping, in which all the transactions are recorded twice, one as a credit and the other as a debit. Any transaction which leads to payment from or to abroad is a credit or debit. The payments are recorded as an offsetting entry to the transactions which are its cause. Suppose a country, say India, exports automobile parts to a foreign country, say US. The US will have to pay for the purchase, which will be a current account surplus for India. The payment can be made in any form, either through granting of credit or bank drafts by the Indian exporter to the US recipient. In both the instances, India's foreign reserves increase and an offsetting deficit is recorded in India's capital account. According to the system of double entry bookkeeping, the balance of payments always balances in principal, where the total value of credit records will be equal to that of the debit records. However, this does not ever happen in practice due to proper unavailability or recording of data. Thus, a record for errors and omissions are included to make the overall balance in payments zero. Equilibrium in balance of payments. The balance of payments of a country depends on the records of transactions both in the current as well as in the capital account. A surplus in the capital or current account records an inflow of foreign exchange into the country, that is, supply of foreign exchange exceeds its demand, whereas a deficit in the current or capital account leads to an outflow of foreign exchange, that is, demand of foreign exchange is higher than its supply from the country. Now that we know what balance of payments means and how it works, let us try to understand what it means to have the balance of payments of a country in equilibrium. A country can have its balance of payments in equilibrium only when the demand for its foreign exchange reserves equals the supply of foreign exchange. That is, when both the inflow and outflow of foreign exchanges from the country are equal. If a country's inflow of foreign exchange exceeds its outflow, it is said to have a favorable balance of payments or balance of payment surplus. Similarly, if the country's inflow of foreign exchange is exceeded by its outflow, it is said to be having an unfavorable balance of payment or balance of payment deficit. If the balance of payment moves against the country, necessary adjustments must be made to improve the same by encouraging more of exports, both in goods and services, and less of imports. Again, a favorable balance of payments of an economy may lead to encouraging of imports for both goods and services, purchase of foreign assets, or granting of foreign aid to other countries in need. A country can never have a permanent favorable or unfavorable balance of payments. What needs to be maintained is that the total liabilities and total assets as of individual countries must balance out in the long term. An equilibrium in the balance of payments, thus, is an indicator of a sound economy. Disequilibrium in the balance of payment is a short-term phenomenon and is balanced out by the supply and demand for foreign reserves possessed by the economy. Balance of trade and balance of payments. One might have a question as how is the balance of trade different from that of the balance of payments? Are they related or are two different concepts? The answer to this is the balance of trade is a major part of the transactions in the current account of the balance of payments. It is nothing but the net exports, that is, difference between value of exports and the value of imports. The balance of trade can either be positive, negative, or zero and determines if the country has incurred a net profit or loss from the net exports. It depends only on the export and import of goods and services and doesn't take into account the transfers and financial asset transactions. A positive balance of trade may result in surplus of foreign reserves in the country, which can be a major determinant of a sound economy. A negative balance of trade can lead to outflow of foreign reserves and can lead to disequilibrium in the economy's balance of payment. The ideal situation turns out when the balance of trade equals zero, that is, net exports equals to zero, which may not necessarily be true in all the cases. The balance of payments is a broader concept and includes transaction records from trade balance, net transfers, and transactions in financial assets, that is, capital account transactions. The balance of payment is an indicator of whether a country is having surplus or deficit of foreign reserves. Any receipt of payments in the form of export payments, gifts or remittances, or selling of bonds leads to a surplus in the balance of payment, whereas any payment such as payment for imports, transfers to abroad, or purchase of foreign bonds leads to deficit in the balance of payments. The balance of payments is a crucial indicator of whether the country is having a stable economy or not. Factors affecting the balance of payments. The factors which affect the balance of payment are divided into two groups. Number 1, the factors affecting the current account, and number 2, the factors affecting the capital account. The factors affecting the current account. The current account may be affected by many factors. They are: number 1, rate of inflation in the resident or domestic country. A high rate of inflation in the domestic economy compared to its trading partners lead to cheaper imports, which lead to increase in purchase of foreign goods. Imports therefore tend to rise with rise in the inflation rate. And it also leads to rise in cost of the exports in the foreign market, as a result of which the foreign nationals will less likely be purchasing the domestic country's goods, and exports therefore tend to decline. Thus, rise in imports and fall in exports will lead to a current account deficit. Number 2, national income. According to most of the empirical studies, an increase in national income of a country in comparison with its trading partners may lead to higher tendency among domestic residents to purchase more of foreign products, which will generate a significant rise in imports and thus more outflow of foreign reserves from the country, leading to current account deficit. And in some exceptional cases, a rise in national income may also lead to improvement in the current account, as it may be associated with increase in production capacity in the economy and surplus generation of exports. Number 3, import restrictions by government. Imposition of taxes such as tariffs by the government on the goods imported leads to a rise in its prices in the domestic economy. As a result, domestic residents will reduce their purchase of foreign products, thereby improving the current account. Sometimes the government also imposes quota restrictions on its imports, which again leads to a decline in the imports and generates a current account surplus. And the fourth factor is exchange rate. The exchange rates measure the prices of the domestic currencies in terms of the foreign currencies. The current account is a function of real exchange rate, that is RER. A higher RER is associated with lowering of exports and increase in imports, whereas a lower RER is associated with higher number of exports and decline in imports. Thus, it can be interpreted that lowering of RER, which might happen through devaluation of currency, might lead to improvement of current account. The factors affecting the capital account. Capital movement across borders is affected by many factors. They are: Number 1. Imposition of tax by the government on the income accumulated by the domestic investors who have invested in the foreign markets. This will lead to lower outflow of capital. Number 2. Economic liberalization might have an impact on the capital account. Number 3. An expected change in the exchange rates may affect the flow of capital as it tends to have an impact on the expected rate of return in the foreign investment. And number 4, changes in the interest rates in comparison to other countries may tend to affect capital flows across borders. A higher domestic interest rate may lead to lower capital flows into the country, whereas a reduction in domestic interest rates may tend to have greater capital flows into the country. You were listening to the audiobook by the School of Management Studies IGNOU for MBA program. Course code MMPC 002 Human Resource Management. Course Coordinator Professor Nayantara Padhi from School of Management Studies IGNOU. Voiceover by Harpreet Kaur. Edited by Jagbandhu Jana. Program assisted by Tarannum Jahan. Program produced by Dr. Manoj Kumar Singh. This program was brought to you by Electronic Media Production Center of Indira Gandhi National Open University.